Hello and welcome to the CNBC-TV18's Mumbai studio. I'm Sonal Bhutra and you're watching MF Corner. Today, it's all going to be about queries that you have written in. So let's welcome Anand Dalmia, co-founder and chief business officer at Fisdom, to answer all those queries for us. Anand, thank you so much for joining us and coming down to the studio because, we've gotten a slew of queries. And it's all about how much can they invest, where can they invest, if small cap looking good, and the big gold rally as well. So I would not waste any time and let's get started. The first one is a caller, in fact. Neela is calling and she's on the line from Tamil Nadu. 25 years old, wants to invest in mutual funds and can invest around 50,000 rupees per month. Neela, go ahead.
Yeah, thank you for choosing our query. This is Neela's mother asking on her behalf. Her current age is 25. She wanted to save 50K per month for her retirement at the age of 45. And she has considering equal distribution, that is 10K in 5 funds, namely SBI Contra, ICICI Prudential Multicap, Nippon India Small Cap, Parag Pareg Flexi Cap, Kotak Emerging Equity. I request the expert's opinion on this. Can she go ahead or any changes are required?
So, ma'am, firstly, thank you for guiding your daughter in the right direction. Yeah. I think you're doing a great job by telling her to invest in retirement funds at an early stage. And good to see that she wants to retire at 45. Yeah. Having said that, I would say that, look, while you've set aside 50,000 per month, as her salary increases, because, sometimes we underestimate what we need at the time of retirement. So it's important that, as her income increases, she keeps stepping up her SIPs. I think the 5 funds that you've suggested are pretty well selected because it's across market caps. So you have, and you have a mix of international as well through Parag Pareg. So personally, I think Flexi Cap, and given her age and the long tenure, I think, the 5 funds are pretty good. Having said that, maybe, given that your tenure is 20 years, yeah. And assuming that she has, the risk appetite, maybe you can look at a micro cap. Maybe the Motilal micro cap is something that you can accommodate along with the 5 funds that you've already suggested.
Okay, all right. That's a very sane advice. Thank you for that. And ma'am, I hope this query was answered. Thank you so much for calling in with that query. So that is what Neela, who wants to retire at 45. That's pretty early. But yes, she does have some plan in place for that as well. Moving on to the next query now. Prasanna Das, Mohan Das, writes to us from Kerala. Says he made investments in a couple of mutual funds and he wants to know whether to remain invested or sell, though he's willing to stay invested for some time if that is more beneficial. So, we of course will need more details in terms of where it is. There's Franklin India Equity Hybrid, Franklin India Small Companies, ICICI Pru Bharat Consumption, ICICI Prudential Value Discovery and Kotak Manufacturer in India. What do you suggest? Of course, some details not there.
Yeah, it's difficult. See, the main thing is your tenure. So if you're saying that you can be invested for some more time, assuming that you need the money in the next year or 2, I think you should start slowly shifting towards debt funds. Having said that, if you fear that, the market will fall after 2 years, so is this the right time? But if you have a longer tenure, then you can shift from your hybrid funds because they can't give the same returns as, a normal equity fund would do. So in the absence of more details, I would say if your goal is almost there and you are there in the next 1 year, then start shifting to debt funds and then, so that there is no volatility in what you want to do. But if your tenure is longer, I think you can shift your hybrid to a pure equity fund, maybe a flexi cap fund, so that your returns accentuate.
Just need a little more details on that, right? How much you're investing there, what the time period you're looking at. Yes, the answer is basis the details that were available. Moving on, Shailesh Singh writes to us from Ahmedabad. He's been investing in mutual funds for the last 10 years. His primary goal is retirement, which is around 7 to 10 years away. He has investments in 6 to 7 mutual funds, but 25% of the corpus is in Mirae Asset Large and Mid Cap, which has been underperforming for the last 1.5 years. He wants to know, should he redeem the corpus from Mirae or wait for some time? Very specific.
It's a very interesting question. There was a time that everyone wanted Mirae Emerging Blue Chip, which is now, the new name is what he said. And the fund actually has underperformed the benchmark in the last two years. Having said that, is there anything fundamentally wrong with the fund? The answer is no. But maybe you can reduce your concentration in this particular fund. So maybe you can move to a quant active fund or a Parag Pareg Flexi Cap fund and reduce your percentage that you're putting in an SIP in the Mirae Emerging Blue Chip Fund.
Okay, all right. So that is something that would help you here. And you're right, like there's nothing really wrong there, but it has just underperformed in last 2 years. Moving on to the next one, K. Kaparia is writing to us from Mumbai. He has made investments in Mirae Asset Large Cap Fund, Kotak Flexi Cap Fund and HDFC Hybrid Equity Fund. He says that he has been investing money in these funds since 2021, but the returns have not been very good. Wants to know the future prospects of his investments.
Look, the returns of these funds versus the benchmark of each of these funds has been good. So I think maybe you were ill-advised into putting money in these funds because these funds are largely large cap. Even the flexi cap has 80% large cap, then you have a hybrid and then you have a large cap. The rally of the last 3 years, when you compare the returns that others are making, you sometimes feel that I have lost out. So in the categories of these funds, the funds are doing well. But if you're looking for better returns or higher returns, then you have to shift to pure equity. So the hybrid fund can be shifted to pure equity fund. And even within that, the small cap and the mid cap funds create an alpha over large cap funds over a long period of time. So maybe you can mix some of that with a multi cap if your risk profile is not that high, or can move to a small cap fund like a quant fund, to further accentuate your returns. But the funds on a standalone basis in the categories are pretty good.
Okay, and we have a lot of queries. You spoke about small caps, so we have a lot of queries basis that as well. But for now, we'll just do one thing. We'll slip into a quick break. When we come back, we have a lot more queries which are lined up, and we'll answer all of them with the expert that we have on the show today. Stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Anand Dalmia of Fisdom. We are talking about the mutual fund queries that you've written to us or posted on social media as well. We have had very fund-specific queries, and there are some more actually, but people do know that there's a particular amount they will be investing and for a particular goal. So Swagat Bhaumik is writing to us from New Delhi. She has a monthly SIP of 26,000 rupees for the last 2 years, and her SIP portfolio is now worth 4 lakh. She also has a property worth 50 lakh. She wants a retirement corpus of 2 crore rupees. She's 35 now and wants to retire at 55. Wants to know if any additional investment or any changes are needed to get to a 2 crore retirement corpus. Anand, it's all about retirement now. People are focusing there.
I'm actually very surprised that young people are now thinking about retirement. But it's very good, something that all of us need, and with life expectancy increasing, I think it's becoming extremely important. Firstly, I would just like to say that this retirement corpus itself, one needs to look at very, very carefully, because you always try and make this mistake of thinking what is the corpus I need in today's term, while in reality the inflation is there. So a 2 crore corpus with what you're saying is your lifestyle today looks like it's less. So the easiest thing as a rule of thumb is keep increasing your SIP with the growth of your income. So if your salary is increasing by 10%, increase your SIP by 10% every year. Hopefully you'll get to the corpus that you want. So today, with 26,000, with the paltry, I would say return of 12-13%, I think, the person will achieve 2 crores. But is 2 crores sufficient is the first question. So I would say look at that very carefully, because, you may reach there and you realize that you've reached the wrong goal. The second is, given the long tenures, because this is retirement planning that you're doing, the first 15 years of a retirement planning, you can be really aggressive, right? So we've seen that, small cap and mid cap over long periods of time have given 5 to 10% alpha over just large mid caps or large caps. And it's important that, you try and put your money in those funds. So, we generally like for someone who's looking at retirement with 20-year tenure to look at a big quantity of around 60 to 70% in mid and small cap. And the remaining 30% can be in flexi cap, which is largely large cap, and large cap fund, so that you don't miss out, but at the same time you are able to generate the alpha. Try and do it in direct mutual funds so that your compounding is even better. And the third is try and diversify. So try and get some gold and some international stocks into your portfolio so that you don't miss on any particular asset class if there is a better performance by any of the asset classes. So on the fund side, I would say look at Motilal mid cap, Quant mid cap, small cap. And maybe you can also look at the Kotak small cap as opportunities that you can invest. On the flexi cap, look at Parag Parik, because it gives you the international flavor. And maybe you can also look at the Kotak flexi cap. So these are the funds that you should split your SIP to achieve your goal.
And as you said, it does give you an exposure to the entire asset class if you want that asset allocation. So that's a very helpful answer, Anand. Let's move on to the next one. Ranganathan is writing to us from Bengaluru, says he has 2,000 units of UTI FlexiCap Fund regular dividend that he purchased in 1st August 1992. His investment horizon is 5 years and wants to know whether he should continue holding or sell. That's called long-term investment, right?
So firstly, I should congratulate you, Rajesh, for one of the people that I have now met who has enjoyed the power of compounding over 20 years. Very few people have kept their holdings for 20 years. I think one fundamental mistake that a lot of us made who invested during that period was to invest in dividend funds, right, when we didn't need the money. As a result, the true power of compounding could not be enjoyed by people who started putting in dividend funds. So when you're looking at your counterparts who've had those funds in growth plans over 20 years, you suddenly feel cheated, or why is my money not grown? But the reality is that you didn't allow power of compounding to work at its peak by investing in a dividend fund. The UTI Flexi Fund, I would say, is a good fund, doing well. However, it has not done exceptionally well over the last 2 years, largely because they chose more growth stocks while value did better. But, it's good to be invested. However, if you want to diversify, I think, and this is the only investment that you have. You should not put all in one mutual fund. I would suggest, look at a couple of others. Maybe if you like flexi cap as a category, then look at Parag Parik and, maybe you split your money into these two. But the fund is doing well, and try and move to growth if you don't need the money on a monthly basis. I think that will accentuate your returns. And, over 20 years, over the next 10 years, you will see the real power of compounding.
Yeah, and he's been invested for 32 years. I mean, that's called the level of patience or the behavioral aspect of investing that we often talk about, right,
Absolutely.
Anand? So, yeah, of course, that suggestion is quite helpful. Let's move on to the next one now. Rajesh is writing to us from Mumbai, says he has invested in a regular fund with a value of about 15 lakh rupees. Adds he now wants to stop his SIPs in the fund and wants to keep it as a lump sum for the long term and start a fresh SIP on the same fund, but direct, not regular. Asks if there would be any implications on compounding.
It's a very good question. First, I think there's a lot of debate about regular and direct. And I would like to say that, look, there is a reason why you choose a regular plan or a direct plan. So if you're a savvy investor, then go for a direct plan because you know in which funds you are investing. If you are a non-savvy investor and you're happy to pay some fee, then you need an advisor. So direct plan, non-savvy, you need an advisor. Otherwise, you'll realize at the end of 20 years that you've not been putting your money in the right funds. But if you need someone's advice, okay, and you don't want to pay fees, then regular plans are the best plans to invest in. So this direct versus regular, I think, there has to be a rule of thumb. Even within direct, a lot of people say direct. I would say, why not ETFs then? If your cost saving is your main goal, then look at ETFs. They've actually outperformed a lot of the direct mutual funds by a distance because of the cost arbitrage. Now coming to his specific case of regular versus direct, there is no tax implication if you shift your existing SIPs to a direct plan. However, if you want to shift the corpus, then there can be a tax implication which can have an impact on an outgo of money, right? Anyways, now we all know that the long-term capital gains is 10%. Whether you pay it now or tomorrow, you still have to pay 10%. But if you want to shift to a same fund, so you don't need any advice because I know which scheme I want, then shift to a direct plan because your power of compounding, as he is asked, will increase because there's a 50 to 80 basis point difference between a regular and a direct plan. And if you save on that year on year, right, at the end of 20 years or 10 years, you'll see that this is a outperformance of 1200 basis to 1500 basis points. So your returns will obviously be more than a regular plan. So if you know the scheme, you don't need advice, go for a direct plan, your returns will be better and the power of compounding will be better.
Who doesn't like 12 to 15% more returns, right?
Absolutely.
For sure. But let's move on to the next one. Ravi Shankar Gopal is writing to us from Pune. He says he's been holding Canara Robeco Emerging Equities since 2016. The net asset value is 184.92 today and his investment amount was around 45,000. He wants to know whether it will multiply to 1,50,000 rupees in the next 1 year. Very specific again.
No, firstly, Mr. Ravi Shankar, many congratulations. Again, we're meeting someone who's been invested for 8 to 10 years in a fund. We meet people who want to churn every 16 months to, 24 months because you're seeing the returns. So firstly, as a rule of thumb in any of these schemes, if you've invested in 2016, in the last 8 years, your money would have multiplied 4 times, on an average. So if you were to check the NAV of Canara Robeco now, he's actually already achieved the 1,50,000 that he wants to achieve. But there is one point I would like to make here. He said, okay, can it reach 1,50,000 the next 1 year? Assuming it's not reached, but he needs that money at the end of next 1 year, then it's important that you start planning today because no one knows what happens in the market in the next 1 year. So whenever you're reaching closer to your goal, you need to start shifting from equities to debt so that, when you need that money on a particular day, you're not at the whims of the market. So assuming that he needs it in the next 1 year, now is the time to shift some of that to maybe a short-term mutual fund or an arbitrage fund, depending upon his tax bracket, and keep shifting every month some money so that he doesn't miss out on the upside, but at the same time he reaches the goal that he wants. But I think he's already reached the goal if he sees the new NAV.
Okay, so I think it's time for him to do this after listening to you. Okay, then let's move on. Pradam Nagpal is writing to us from New Delhi. He wants to know if he can invest in small cap funds. The small cap debate. Do you think it's ripe for investment now, or it's still a place you would, or a space you would stay away from?
See, I would say, look, first let's understand what is a small cap, right? So SEBI now today has a categorization which says that if you put all the listed equity stocks and you put them in a descending order, after 250, so 251 onwards, it's all classified as small cap.
Oh.
Okay. So earlier, like a few years back, someone would ask, what's a large cap when SEBI has not done the categorization? So someone will say, okay, any company above 10,000 crores is a large cap. Today, there are many companies above 20,000 crores which are classified as small caps. So all the nice IPOs that we see largely are all coming in that category because now after 250, because the 250 is already done, so largely companies are coming there. So small cap is no longer those 500 crore market cap companies. There are many companies with 20,000 crore market caps. That's how the markets in India have expanded. So it's no longer as dangerous, as one would think in the past. Now let's look at history. Do they give returns? The answer is yes. So if you look at a 3-year, 5-year, 10-year period, they have outperformed the large caps by 10%. They have outperformed the mid caps by almost like 5%, which is a huge, if you consider the power of compounding on top of that. So should I invest there? Should I miss out on that? The answer is no. However, few things that you need to keep in mind. One is your tenure of investment. So if your tenure of investment is shorter, don't invest in small caps because the returns can be lumpy. You don't know when those returns are going to come in. The second is your risk profile. If you don't have the heart to see your money coming down, then try and avoid them. Then try and taste them through a multi-cap or a flexi cap fund. They may have a part of it in small cap. But if you are there for the longer period, like a lot of people came and spoke about retirement, right? And you have the risk profile, you have the tenure on your side, there is a big part of your money that should go into small caps because that's where the alpha will get created. Also, we have had this debate for a long time around, active versus passive mutual funds. So if there's one category in which the role of the fund manager is very, very prominent, I would say it's small cap because, the number of companies is very large in that universe. It's not all well researched. The future leader all comes from there, and that's the reason they are able to create the alpha. So if you are looking at higher returns and you have the risk appetite and a longer term period, small caps is something that you should invest. However, the other thing you can do to make sure that you don't get on the wrong side of it is to try and take the path of a SIP or an STP rather than putting all your money in a go because you don't know whether it will fall or it will go up. And last point I would say is that recently I think I personally started getting a bit more comfortable on small caps after the SEBI stress test because the results were pretty nice to see that look again we all thought that what happens in a falling market I will not be able to exit. The stress test results were pretty good to show that look the entire fund can be exited in 40 days time, and as I said it's happening because there are 20,000 crore market cap companies in that small cap universe. So we like that category for people with higher risk, long-term tenure, but try and do it through an SIP or an STP I think you'll make the returns.
It's such a comprehensive answer. So, you know, you have to take care of a lot of things, especially if you're a long-term investor. Maybe look at small caps. Also, if you have the risk to invest in that particular category. So, my director tells me we have 2 minutes, so we can take one more query. Ravi Kumar Kalgi writes to us from Pune. He asks if it is the right time to invest in gold fund or ETFs. He says he already has a demat account, whether he should invest in mutual funds or sovereign gold bonds. Another very interesting category here.
See, look, each one of us wants to chase something where the returns have been very good of late, right? So gold has been exceptional in the last 6 months, 12 months in terms of returns. Now, first, let's look at gold as an asset class, and then we can decide which is the best path to make sure that we have gold in a portfolio. So I would say gold as an asset class does well over a long period of time. We have always suggested to our clients that between 5 to 15% of a portfolio, you should try and invest in gold, right? Because especially with all this geopolitical uncertainty, it's good to have a part of your portfolio in gold, and that's the reason gold has been doing so well. But what is the right way to maximize my returns? Now, unlike stocks, gold is gold. You can't have multiple stocks, you know, where you can create alpha. But the government has come out with something very interesting called sovereign gold bonds, where they give you 2.5% assured return on top of the returns that you make through your gold investments. The second is, this is the only category now wherein if you hold for 8 years, your returns are tax-free. So if you look at the last tranche that just matured, 2016 tranche, 8 years, it has outperformed gold ETFs and gold mutual funds by 400 basis points, right, on an XIR basis. So obviously, if you have a longer tenure, go for SGBs. There's nothing better than that. You can buy SGBs both with and without demat. So that's the other beauty of SGBs. When it comes to pure mutual funds, the beauty of mutual funds is that you don't have to be invested for 8 years. You can be invested for 6 months, 1 year. You want to play the rally. But there you should try ETFs over mutual funds because there's an expense ratio difference of 25 to 30 basis points or sometimes 40 basis points between an ETF and a mutual fund. And as a result, you know, over a longer period of time, you'll make better returns. So on an average, I would say ETFs make 20 basis points better returns than gold mutual funds. And that is the reason the difference between the returns. The last is between mutual funds. Why is there a difference, right? If it's only gold. The reason is timing and, you know, what cash you put in there. And the third is the expense ratio. So you should look at mutual fund wise expense ratio. You should see what is the level of cash they're holding and the quantum of investments that they've already made. So that's the reason for the difference. But it's overall, you know, ETFs for the shorter term and SGBs for the long term.
Okay, that's a very precise answer again, and hope that helps our viewers as well. Thank you so much for coming down to the studio and answering all those queries so patiently. Always a pleasure speaking with you. With that, we'll take your leave on this show today, but stay tuned. Closing bell will take you through the last hour of trade.